Welcome to Talk Tickers. We dive deep into earnings calls so you don't have to.
We're here to break it down.
Today, it's Cheesecake Factory Incorporated's first quarter 2025 earnings call.
Yep, KKE.
And the headline seems pretty positive, right? Solid quarter overall.
Definitely. Revenue came in towards the higher end of what they guided for, about $927 million.
Okay.
But the real story, I think, was profitability. It actually beat their expectations.
Beat expectations. How so?
Well, their adjusted earnings per share, that jumped 27% compared to last year.
Wow, 27%. That's significant.
It is. And get this, it's the sixth quarter in a row they've seen EPS growth of 20% or more.
Sixth quarter. Okay, there's clearly something working well there. We need to figure out what's driving that consistent profit growth.
Absolutely.
So looking beyond just the EPS number, what about the core Cheesecake Factory restaurants? How did sales look?
Comparable sales were up 1%. Modest, but positive.
Right.
And their annualized average unit volumes, AUVs, they're now over $12.5 million.
$12.5 million per restaurant annualized. That's pretty impressive volume.
It really is. And crucially, their restaurant level profit margins improved too, up to 17.4%.
17.4%. How much of an increase is that?
That's 140 basis points or 1.4 percentage points, better than Q1 last year.
Okay, so they're not just selling, they're selling more profitably, finding efficiency.
Exactly. Seems like better execution on the ground.
And they're still focused on growth, opening new places.
Oh, yeah. They opened 8 new spots just in Q1.
8 already? What kinds?
It was a mix. 3 North Italias, 3 Flower Childs, and 2 FRC restaurants.
So heavy on the newer concepts.
Seems to be the focus for expansion.
Yeah.
And they're still planning for, I think, up to 25 openings total for the full year 2025.
25 openings. That's still quite ambitious. Shows confidence, I guess.
For sure. They clearly believe in the potential across their portfolio.
Okay, so let's unpack the why behind these numbers. Operationally, what were the key things they talked about?
A big one was better retention, both managers and hourly staff.
Staff retention. Interesting. How does that help?
Well, they directly linked it to a better guest experience. Happier, more experienced staff means better service, right?
Makes sense. Less turnover, more consistency.
Exactly. And they said their guest satisfaction scores reflect that, improving both from last quarter and year over year.
So investing in people seems to be paying off directly.
It really looks that way. And that flows into the margin expansion we talked about.
Right, the higher profitability. So it's operational execution for the guest experience.
That's the connection they made. Running the restaurants better while keeping the quality high.
Got it. Did anything else stand out operationally? Maybe marketing?
Actually, yeah. They highlighted a recent menu change, added over 20 new items.
20 new items, that's a lot.
It is. And apparently it got a ton of media attention. They estimated something like 8 billion potential PR impressions.
8 billion with a B.
That's what they said. Massive potential reach. You have to think that helps drive some traffic.
No kidding. What about their loyalty program? Cheesecake Rewards. Is that making a difference?
It seems to be growing well. They mentioned strong member acquisition and positive feedback.
Okay.
And they're also shifting strategy a bit there, moving towards more personalized offers for members.
Tailoring the deals. That's usually a sign of a maturing loyalty program, right?
Yeah.
Getting smarter with the data.
Exactly. More targeted, hopefully more effective.
Okay, let's break down the performance by brand a bit. North Italia. How do they do?
North Italia. Well, their annualized AUVs increased 1%, hitting $7.75 million. So, good volume.
But I sense a but.
Yeah, but their comparable sales actually declined by 1%.
Declined? Why was that?
They pointed to the impact of the fires in Los Angeles, since North Italia has a smaller base of restaurants compared to Cheesecake Factory.
A localized event hits them harder percentage-wise?
Right. But on the plus side, their restaurant level profit margin, for the mature locations anyway, did improve to 16.6%.
So improving profitability even with that comp sales dip. Interesting.
Yeah, suggests good cost control maybe.
All right. What about Flower Child? That one always seems to be doing well.
Oh yeah, Flower Child is still really knocking it out of the park, relatively speaking.
How so?
Comparable sales were up 5%, which they noted significantly outperformed the fast casual index overall.
5% is strong, especially if the category is lacking.
Definitely. Their annualized AUV is now over $4.6 million. That's up 6% year over year.
Wow.
And their restaurant level margin is also really healthy, up to 18.6%.
18.6%. Flower Child seems like a real winner for them. Strong sales, strong margins.
It really does. It's consistently showing strong growth and appeal. What do you think is driving that specifically in fast casual?
Good question. Maybe the health focus. Freshness, it's definitely tapping into something. Okay, let's pivot to the overall financials in a bit more detail. Revenue, $927 million, you said. What about net income margin?
Adjusted net income margin was 4.9% for the quarter.
4.9%. And how did that compare to their forecast?
That actually beat the high end of their guidance range, so better than they expected.
Okay, good news there. They also mentioned a big financing move, right? Something about convertible notes.
That's right. They issued $575 million in new convertible notes.
Why do that? What was the strategy?
It seemed like a way to reshuffle their debt and capital structure. They used the money to repurchase some older notes that were due in 2026.
Okay, managing upcoming maturities.
Right. And also to buy back some of their own shares and, importantly, pay off their entire revolving credit facility.
Paid off the revolver entirely. That improves flexibility.
For sure. And through the share buybacks and the regular dividend, they returned about $154 million to shareholders in Q1 alone.
$154 million back to shareholders. Signals confidence, you could argue.
Often interpreted that way, yes.
How did the cost lines look? Any big moves in cost of goods or labor?
Yeah, actually, cost of sales was favorable. It decreased by 100 basis points, so full percentage point.
Nice. Why was that?
Mainly better commodity costs.
Yeah.
Things they buy got a bit cheaper, sounds like.
Okay. And labor, with the focus on retention.
Labor as a percentage of sales also went down by 30 basis points. That probably reflects that improved retention and maybe some productivity gains.
Makes sense. Fewer training costs, more experienced staff.
Exactly. Now, other operating expenses did tick up slightly by 40 basis points.
What drove that?
They pointed to marketing spend, costs associated with the rewards program, and some facility-related expenses.
Okay, understandable. And G&A, general and administrative?
That actually decreased by 30 basis points.
Right.
They said it was due to lower professional fees in the quarter.
Interesting. So putting it all together, the adjusted earnings per share was
93 cents for the quarter.
93 cents. Got it. And what about their balance sheet position at the end of the quarter? Cash and debt.
They had about $52 million in readily available liquidity, mostly cash.
Okay.
Total debt outstanding was $644 million on a principal basis.
$644 million. And capital expenditures. How much did they spend on building and upkeep?
CapEx was around $43 million in Q1, mostly for those new restaurants and maintenance on existing ones.
All right. Let's look forward then. What guidance did they give for Q2?
For the second quarter, they're expecting total revenue between $935 million and $950 million.
So potentially a slight sequential increase?
Potentially, yes. On the cost side, they're modeling low single-digit inflation for commodities.
Okay.
And low to mid-single-digit inflation for total labor costs.
Seems manageable. And the bottom line for Q2?
They're forecasting an adjusted net income margin between 5.3% and 5.4%.
So a bit higher than Q1's 4.9%.
Correct.
And what about the full year 2025? What's the big picture?
For the full year, midpoint revenue guidance is around $3.76 billion.
$3.76 billion.
They expect overall inflation across commodities, labor, other OPEX to land in the low to mid-single-digit range for the year, and that includes the current known tariffs.
Good to know they factored tariffs in. What about costs for opening those 25 new restaurants?
Pre-opening expenses are budgeted around $34 million for the year.
Okay. And the full year profit margin expectation?
Still expecting approximately 4.75% for the full year adjusted net income margin. So holding steady on that guidance from before.
Holding steady despite some headwinds. Now, you mentioned they sounded a bit more cautious about the economy.
Yeah, they did acknowledge the macro environment looks a bit more uncertain now.
How did that affect their outlook?
It led them to slightly adjust their full-year revenue outlook towards the lower end of their previous range.
Why?
They cited recent downward revisions by economists for things like overall economic growth and, importantly, consumer disposable income.
Ah, okay. So seeing signals that the consumer might be getting squeezed a bit.
It seems like they're just being prudent, reflecting that uncertainty in their forecast.
And you mentioned tariffs. How confident are they about handling those?
Pretty confident, it sounded like. They believe they can absorb the impact of the current tariff levels without having to change that full-year margin guidance of 4.75%.
What levers do they have?
They talked about finding more operational efficiencies, working with their suppliers,
Yep.
and maybe, if needed, taking a small amount of extra pricing, like 50 to 75 basis points, 0.5% to 0.75%.
So relatively small price adjustments as a last resort, basically. Shows some resilience in the model.
Yeah, it suggests they feel they have some control over costs and pricing power.
Okay, so summing it all up for someone tracking this company, what are the key takeaways from this call?
Well, first, the Q1 performance was strong, especially on profitability. That EPS growth is hard to ignore.
Right, the sixth consecutive quarter.
Exactly. Second, their commitment to new unit growth remains firm. Management clearly sees runway for their brands.
Even with the economic caution.
Right. Third, that caution is notable. The slight tweak down on revenue guidance reflects the broader uncertainty everyone's talking about. Prudent guidance.
Okay, what else?
Fourth, their ability to manage costs, including absorbing tariff impacts without hurting margin guidance, is a key point for assessing resilience.
Yeah.
Fifth, the brand performance. Flower Child's continues to be a star performer, and North Italia is improving its margins, even with some sales headwinds. Shows the potential there.
Good point. And maybe a final one.
Yeah, finally, don't underestimate the impact of those operational improvements, particularly around labor retention and productivity. That seems to be a core driver of the better profitability.
Makes sense. Better run stores make more money.
Fundamentally, yes.
All right, time for our favorite segment. This is not financial advice, where we spin some, let's call them outrageous but plausible trade ideas based on the call.
Love this part. Okay, so two things kind of stuck out from their commentary today.
Lay 'em on us.
One was this subtle mention maybe of a bit of a negative mix shift, people potentially choosing more value items, maybe a slight pullback on higher margin things like alcohol.
Okay, value-seeking behavior.
And the second was their continued emphasis on strong off-premise sales, specifically highlighting the stability of delivery even as they build their own channels.
Interesting combo. So what are the trades?
Okay, outrageous idea number one. If consumers are pulling back slightly on alcohol when dining out, but still want something interesting, maybe go long on companies focused purely on premium non-alcoholic beverages.
So betting that trend benefits the specialty non-alcoholic players more directly than the restaurant itself?
Exactly. Maybe people trade down from a cocktail to a fancy craft soda or mocktail.
Yeah.
Those specific beverage companies could capture that spend. It's a niche play on that potential mix shift.
Okay, I can see the logic, however thin. What's number two?
Idea number two relates to the delivery stability. Cheesecake Factory, like many big chains, is investing heavily in its own digital ordering and pickup. They highlighted strong off-premise through their channels.
Right, making it easier to order direct.
So the outrageous idea. Consider a short position in a third-party delivery platform that gets a big chunk of its business from these large casual dining chains.
Short the delivery apps. Why?
The thesis is, as chains like Cheesecake Factory get better at driving customers to order directly through their own app or website for pickup, or even their own delivery, they might slowly eat away at the share going through the third-party platforms.
Disintermediation. The restaurant captures the customer relationship and maybe the economics, cutting out the middleman?
Potentially. Over the long term, if direct ordering gains enough traction, it could pressure the commission revenue the delivery platforms rely on from these big chain partners.
Two very interesting, definitely outrageous but plausible ideas there.
Good.
And just to reiterate for everyone listening.
Not financial advice, just thought experiment.
Absolutely.
Yeah.
Purely for discussion. So, lots to think about with Cheesecake Factory. What are your key takeaways? Do you buy into these consumer trends or delivery dynamics? We always want to hear what you think.
Yeah, join the conversation.
And make sure to join us next time on Talk Tickers as we break down another important earnings call.